You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. I'm your host, Kevin Molen, and with us is our ever-present co-host, Charles Steinmetz.
Morning.
Charlie, everything going all right for you?
It's going all right.
Cool. As our usual segue, is there anything you want to tell me about today before we get started?
Getting older and not sleeping all the time is like a bad mix. You're just not sleeping your full night or staying up too late because you just try to be young and it doesn't work anymore as you get older and older and older. So it catches up with you.
I'll never forget, I was, I had stayed up all night one night. I
Sure.
was 17, I think.
Sure.
And I was talking to another adult, and they basically said something along the lines of, "Oh, well, I'll never be able to do that again." And I'm like, "Why not? I mean,
Yep.
it just takes determination and
Sure.
and will. Like you can."
Yeah.
Now, whether you'd have a good reason to or not is another matter.
Sure.
Of course, as a 17-year-old, it's never a good reason to
Sure.
begin with. But then I found that that is true in my older age.
Yes.
Okay.
Anything that you have to share, put it on your mind?
Honestly, really today I don't. Things have been, after the tax filing deadline had ended, and now we're just into project mode, and so it's all of the research projects and the things that had to be pushed off till after the deadline, and so staying real busy, but nothing in particular I want to go over today. Instead, I'd rather just jump right in.
Sure.
So today's something that I'm pretty passionate about. We're talking about budgeting and finance. So this is going to kind of be a soapbox episode for all intents and purposes. Yeah, because there's a lot of opinions and viewpoints on this. As per usual, this is not necessarily a science. This is more of something that I have opinions and a viewpoint on. My opinions are based on math. They're based on financial principles, economic principles, and my opinion. And a lot of people could disagree with one or many of my points. And so just take it for the spirit that it's given in, which is here's my viewpoint on finances and budgeting. I do work with people in this regard in particular and go through their bank records and help make plans, and help set budgets and all of that. But there's not kind of a silver bullet for this. I will compare budgeting to dieting in several cases today. And just like that, there's not one diet that works for everybody, right? It varies. What works for you is what matters most.
Well, with budgeting and even with dieting, I mean, there is a fact-based truth to it as well, not opinion-based. It is you need to live within your budget. You make $1,000 a month, you spend $1,500 a month, you're going to be in trouble.
Yes.
Right? You intake 2,000 calories and you expend 1,200 calories, you're going to have a problem.
Yep. About 3,500 calories to a pound, and so you do that enough times, and those pounds add up.
They do.
So, okay. Well, let's start with some facts, right? Because we can jump into some fact-based items. There was a survey done in 2018 that showed that 42% of retirees had less than $10,000 in savings. So let that sink in.
So, because statistics can be construed really weird ways. When you say savings, like in their savings account in the bank, or that is including all retirement accounts?
We're talking about all retirement
All
savings
assets.
combined. Yes.
Okay.
And so a really large majority of people rely on Social Security and their children and that type of stuff in order to care for them. Now, there is, interestingly enough, and I'm not going to get too much into the science of this, but evolutionarily, that's a word, right? Evolutionarily?
Now,
Yeah, evolutionarily based. When how do I put this? when you are worried about money, when you're worried about day to day, when you're worried about kind of the subsistence of the species, you have more children, right? When you are more affluent, more healthy, more your lifespan is extended and all that kind of stuff, you generally have fewer children and focus more on developing yourself. Again, I'm not
Seems opposite, but okay.
I'm not a science person.
Sure.
I'm not a well. You're thinking it seems opposite because children cost money, and by having less money, you
Right.
can afford to have less children.
Thanks.
But the reality is
I get it,
people
yeah.
rely on their children to take care of them, right? When they get older, and so this is one of those scenarios where it's certainly in certain cultures, people rely on their children in order to care for them. If you don't want to be a burden on your children and you don't want to be part of the 42% of people who retire with less than $10,000 saved for retirement,
Sure.
then you have to take certain steps in order to not be in that percentile. And the reality is most people in that percentile didn't have to be there. They could have been in a better place. You just have to make different decisions. It's just like losing weight, right? If you want to lose weight, you have to make the decisions necessary to lose that weight, and if you don't, then you won't. And so, want to start out with that point just to set the stage, because most people, in my professional experience, you should begin to plan for retirement within 30 or 40 years of retiring. Most people begin to worry about retirement within 10 years of retiring, and the math doesn't work that way. And we'll illustrate that as we go.
10 years saving just to live from 65 to 85. I wish.
Yeah, and it becomes more problematic because people are generally living longer, and so life expectancy tables were usually around 82 for males and 85 for females. But those tables are constantly being adjusted, and they're only going up. And so the chances of you living to 90 are getting higher and higher. And 5 years of which, from 85 to 90, there's no way you're going to be working from 85 to 90. You're just burning through your money, right? You have to have money set aside. So now that we've talked about kind of the end of the spectrum, right? The people who retire who don't have enough money. Let's talk about kind of what we need to do in order to get to a good point. Any thoughts so far?
I have some contradictory thoughts, but they're not helpful, so continue.
Okay, sure. There is no replacement for time. So there have been a really tremendous amount of studies, and you could search this on Google quickly and find a whole bunch of illustrations and all kinds of stuff. This was all the rage. Oh, geez, I'm showing my age by using that phrase. But this was a big deal in the 90s. They ran a tremendous amount of simulations for 17-year-olds. Basically, when Roth IRAs became available, this was in the late 80s, I think, was when the Roths were created, but the 90s is when they were generally adopted. When Roth IRAs became available, there was a lot of simulations run. You have to have some earned income in order to contribute to a Roth IRA, but there are some income limitations. So you can't make over a certain amount,
right,
but you also have to make at least a certain amount.
Right.
So what they did is they had a 17-year-old who earned $5,000 at a summer job and contributed $5,000 to a Roth IRA. And from 17 to 26, so those 10 years, contributed $5,000 a year. So that's $50,000 from 17 to 26. This money was invested in the market. Mm-hmm. And by the time that 17-year-old was 65, it was $1 million. So this simulation has been run in really sophisticated ways over and over and over again. And this is from a statistically proven point. It is fact. Now, the reality is it can vary depending on when you're in the market and when you invest and right, how you invest. And there's a lot of factors to it. But the reality is there's no replacement for time, because a 27-year-old who contributes $5,000 a year until they're 36 ends up with a far lesser result. In a lot of cases, that was $300,000 to $400,000.
Sure.
And it's the same money, it's just in a different time period with a far different result. And there's a lot of fundamental economic principles that leads to that, that we're not going to dive into because I'm not the kind of the macroeconomics expert. And so we're not going to dive into that, but feel free, again, hop on Google and just search something along the lines of Roth IRA simulation for 17-year-old, and you're going to find this data very, very quickly, very easily.
One of the reasons I would bring up the Roth IRA, because you could invest in the market in general and still have the same yield, whether it's a Roth, a traditional, just the market. It's not going to change the growth of it, but the benefit of that Roth IRA, just to recap, is putting the money in is not a deduction to your taxes. You still pay tax on all the income that you have, but that $1 million they retire in that Roth IRA, because it's been done correctly. When that person goes to retire, their retirement is, they don't file taxes. You don't have any tax obligation whatsoever, which is a big boon and quasi part of the growth you might have in that account as well. If you don't have to factor out the 15-20% tax you end up paying on that, that helps you maintain that retirement account for longer too.
Yeah, absolutely.
So Roths can be, if you can afford, they can be great. They're not the only thing, but they can be great.
Yeah, to get from $50,000 to $1 million, you have to have a lot of gain.
Yeah.
That gain outside of a Roth IRA is taxable as you sell or realize your gains by selling stock. And the lower principal, it means you have lower basis, which means you have lower gains overall. And so anyways, but the point is to illustrate that there's no replacement for time. You have to make the right decisions sooner rather than later. Now, any time to make the right decision is better than making consistently the wrong decisions, right, for financial purposes. And so if you are 10 years away from retirement and you're ready to make the right decisions now, fantastic. Congratulations. Making the right decisions now will help set you up better for retirement. You will have more than $10,000 set aside for retirement. But this is one of those scenarios where you just can't wait until the end and hope that everything is going to be fine. Hope that you have an affluent child who can take care of you, or hope that Social Security is actually going to be there. You should not hope for those things. Now, those things may be true, in which case, great, but you shouldn't hope for them to be true, because you're talking about literally your ability to care for yourself and not be a burden on those you love. And so beyond that, I had mentioned that good budgeting is like a diet, and the reality here is you could have a perfectly strict diet and fail to live up to that diet because it's too challenging.
Sure.
It eliminates too many foods that you enjoy. It eliminates too much. It's too restrictive, and so you just can't consistently achieve it. And when you're unable to consistently achieve it, then the diet fails. So some people go for a lesser or less restrictive diet.
Sure.
That will work because it allows them to have a cheat day, or it allows them to have a couple hundred more calories a day, or it allows them to eat a type of food that they really enjoy that they wouldn't have with another diet. And then these people end up losing more weight than the person with the highly restrictive diet, because the highly restrictive diet, the person on the highly restrictive diet just cracks.
Starving at midnight when you eat something.
Yeah, don't eat at midnight. But anyways, and so having good budgeting is all about what works for you. If you're married, finances can be a really big sticking point in marriage. A lot of people can stumble in that area. I think the last time I looked at it, something like 28% of separations and divorces were due to finances, if I remember that statistic right. Don't quote me on it, but I do believe.
Probably way higher.
And that could be the case. But it was a pretty shocking number.
Yes.
Because finances can be very difficult. So I work with folks who the husband and the wife differ in how they want to handle their finances, and that can be a challenge because we're trying to find a plan that will work for their household and their family budget. And when you start looking at stuff like how much you're spending each month, and you see where the money's coming from, so I've seen some interesting scenarios. I see scenarios where people are dining out a really tremendous amount. I saw some scenarios with multiple personal trainers, that are being paid monthly. I've seen I had a client who purchased too many books. His primary sticking point was he bought too many books, and he went back and looked at the amount of books that he purchased in a month. It was always so much. He was in education, so it's great reasoning, but it was so much that he was spending on books. And so in that client's case, one of the things that we looked at was we had a date every month. The 15th of every month is when he would buy books. So by purchasing all the books on one day, he really got a good idea of how much he was spending on a per month basis on books. And so the theory here is there's a lot of different ways to skin this cat. The phrase that I will use that I hope really sticks in your mind is what is measured improves. The other way to say this is what is inspected gets respected. But essentially they're the same thing, which is if you're not looking at the amount of money that you're spending, if you're not looking at your budget, if you're not looking at what's going out, then how could you ever expect it to improve? And so one of the things that my wife and I began doing was meeting every Sunday to look at the money that we spent the previous week. This was transformative in the way that she and I viewed our finances. We didn't really budget, and budgeting is essential for some families, and budgeting for others may not be very helpful at all. Having a strict budget can hold you very accountable. So I'll use Dave Ramsey as an example. His program, Financial Peace, which if you're struggling with your finances, psychologically, Dave Ramsey is the answer. In almost all cases, if you have some psychological disconnect with the way that you view, see, or spend your money, Dave Ramsey will give you a tremendous amount of insight.
Can you do a brief recap of what, because all I really know, I haven't done anything, is just people that I meet, all the impression I get is the Dave Ramsey is the don't have any debt. That's all really I know. Dave Ramsey is don't have debt.
Yeah. To be fair, you have just summed up Dave Ramsey's view on finances by saying don't have any debt.
Don't have any debt.
For all intents and purposes, that is his viewpoint.
Okay.
You need to be out of debt. Now, all of his advice stems from how to get you to that point. Right?
It's like the snowball method, his thing, or somebody else's, or
yes. So
okay.
so a couple of points. Number one, he created what's called the envelope system.
Okay.
And so, well, I say he created. He popularized the envelope system. Is probably the better way to say this. He popularized the envelope system, which is basically once you have money, right? You've got payday or whatever. You take the cash from that and you assign it to your budget of the different envelopes for the different things: dining out, electric bill, water bill, car payment, insurance, that kind of stuff, right? And you put it in the envelope. When the money in the envelope is spent, the money is gone. So groceries, travel, whatever, entertainment, once it is spent and you are done. And then you have to figure out how to make it work the rest of that, week or month until the next pay period. It forces you to make decisions based off of what you're allowing yourself, as opposed to just looking at the money in your bank account and saying, yep, exactly. Right. Or worse, looking at that credit card thinking, I'll be able to pay it off next month, and swiping that card and spending money that you don't have, which is where most Americans get themselves into trouble. The problem is we really are a credit-based society. Tell me something that you can buy on credit tomorrow. What's something that you could buy on credit tomorrow?
I think groceries, a computer. I can't buy a car on credit, but there are some people I'm sure that could get a car just on credit.
Right. So well, but financing, right? I'm not talking about a credit card. Can you buy a car using financing? That's credit, right? You're being credited money that you don't have.
Yes.
A house, you can buy almost anything. I could walk into Fingers Furniture and get 0% interest furniture for 6 months, right? Or I could go to Cons and buy appliances at 0% interest for a year or something like that, right? And then what I would do is I would make token payments until the interest is due, and then suddenly, not what I would do, but what generally Americans will do is they will make token payments, and then suddenly it's a 26 or a 34 or a 40% interest rate on this credit for the next 4 years while they get stuff paid off. I mean, that's literally eating your lunch, right? That those interest rates are insane. Now, taking advantage of credit can be very wise if you do so deliberately and with good strategy. Dave Ramsey's viewpoint is you shouldn't use credit because generally Americans and humans have shown that they won't respect that. So he just says it's off limits. No debt, right? Don't buy anything on credit. If you can afford it, you can afford it, and you pay for it with cash. You don't use credit, right? Not student loans, not homes, not vehicles, nothing. And so he takes very extreme. One of the things that he likes to say on his podcast is rice and beans, right? You're going to eat a lot of rice and beans. I know that prospect potentially is enjoyable to you, but he says rice and beans until you get this stuff under control, and because you can eliminate food is fuel for your body, right? And so you can eliminate some of the enjoyment of food in order to give yourself more cash flow in order to pay off debt so that you don't have it. Right. So Dave Ramsey's book, Financial Peace, covers a lot of different things, but those are some of the finer points of his philosophy. Where Dave Ramsey really attacks budgeting and finance is philosophically. It's psychologically. It's how it makes you behave. His is not actually a math-based approach, right? So one of the things you mentioned, the snowball method. One of the things that he recommends is paying off the lowest debt first, right? So you have let's
whatever it is blind.
Yeah, $1,200 of
what's left in your car.
Yeah, something, whatever. And let's say it's a really low interest rate, but then the next lowest loan that you have is $5,000, and the next one you have is an $8,800 credit card, and the next one, right? And so what happens is he says you can pay off the $1,200 one faster than any of the others. By paying off the $1,200 loan, you create $100 more theoretically of cash flow in your month-to-month income. So now you have $100 more. So you take what you were paying for the $100 for the $1,200, because that's one you were focusing on first, plus the $100 now that you're saving by not having to pay that $1,200, getting the $100 per month. So now you have $200 more of cash flow. You take that $200 of cash flow and you apply it to the next lowest debt.
Right.
Then that $200 of cash flow plus, let's say this one's $150. Once that's paid off, now you have $350 of cash flow. You take that $350 and apply it to this, right? So it snowballs so that you can get it paid off. This is mathematical. It can be challenging to limit yourself financially, but it's not a difficult concept. The snowball concept is not a difficult one, right? You create cash flow, you use the cash flow to pay off the debt. This has helped a really tremendous amount of people to get out of debt. So he is a kind of a household name for budgeting and finance simply because of the psychological approach, not the math-based approach. I'm a math guy, so I look at this mathematically. If I've got a mortgage and the interest rate is 3.25% and I can earn 5% in the market, why would I pay my house note? Why would I pay more principal to my house.
Right.
Why would I pay my house off? I am the bank in this case. I'm earning more in interest than I am paying. Why would I use my extra cash flow to pay down my house? I will just invest more.
Sure.
But Dave Ramsey says no. Dave Ramsey says all the debt should be gone. Pay it all off.
Right.
Now, what ends up happening with Dave Ramsey is he's very financially successful, right? He's probably got a net worth of 250 million, I think, last time I looked. And so he's super successful, which is great. Dave Ramsey does not need a credit card. He doesn't. He's got the money in order to buy what he needs to. The interesting thing is Dave Ramsey probably couldn't qualify for a loan. He probably couldn't qualify to buy a car on financing or a house through a mortgage because he's not on the credit radar. So your average Joe really needs to be on the credit radar. And so while Dave Ramsey may say, hey, don't have credit cards, cut them all up, I say you need a credit card. You just need to be paying it off every month. But you need a credit card because you need to be on the credit radar. You need to be seen as a good debtor. So
I had a bad experience with that in my life. I did not heed my father and got a card when I was younger. And so by the time I was 22 or so, I went to, I was getting married, so trying to run my honeymoon kind of charges. And it was just the convenience factor of let me do the credit card and have some cash for it, and then I can do the thing after, which worked. But when I was going through the process to do that, trying to apply for a credit card whenever you had nothing, especially older and later in life, I had an apartment, I had no assets, no 401, nothing to look at. It wasn't a bad credit situation. It was a you don't exist in our world situation. Therefore, we won't talk to you. Yeah. And so, sure, I mean, if you're financially successful and can just buy a car, buy a house outright, great. But having a credit card, just pay groceries, buy groceries, pay it off immediately.
You need to be on the radar.
Build that up. I mean, I did it within 6 months. I got up to a pretty decent rating to be able to do what I needed to do.
Yeah.
And like the first apartment I got, because I wasn't on any kind of credit radar, I had to put $500 down just to turn on the lights.
Yeah.
It was horrible. If I had credit, I wouldn't have to do that.
Yeah, for sure. So you really do need to be on the credit radar. Now, again, what is measured improves. And so the question is, what is your method of reviewing your finances?
There's no best tool or anything. Do this.
Oh, there are a tremendous amount of tools. I'll give a shout out to Mint. Mint, a lot of people use Mint. Mint is a budgeting software. It is probably the most popular budgeting software. There's a lot of budgeting softwares that are based off of Mint's platform. But the reality is that's just numbers. A budget is pretty simple. You decide how much you want to spend on certain things, and then you make sure to spend only that much on certain things. And so I don't want to spend a lot of time talking about budgets because they're real basic. You can find a lot of different budgets. A lot of people think that budgets make the difference, and they don't. You holding yourself accountable makes the difference.
Actually doing it.
Mm-hmm. And so whether you have a budget or not is irrelevant because you can not have a budget and be willing to hold yourself accountable. And for example, I've got 3 children, and so I've got a 12-year-old, a 9-year-old, and a 2-year-old, and a little bit of a spread there, right? We tried a couple of years to have a third one, and it just wasn't happening until it finally did. But when the third one came around, it became very convenient to just have dinner delivered, right? DoorDash, Grubhub, or whatever, just have something delivered because I was going to be working late, and my wife Sarah was spent all day trying to clean or trying to corral the kids, or with the newborn on top of everything else, very challenging, right? So it was very convenient.
Sure.
Well, why don't we just do this for tonight? And it was always a just for tonight kind of thing.
3 times a week.
Until we looked back at one point, we were spending $700 a month on dining out. And when I saw that number, I lost it. And obviously I was part of the problem, but I lost. I was like, this can't happen. We can't be doing this. And so one of the things that again that I mentioned is that she and I would look at the bank account every single month. And again, what is measured improves, because I knew that I was going to have to view this bank account with my wife at the end of that week. I knew that anything I spent, I would hold myself accountable, and she would hold me accountable.
Right.
And so we were just constantly talking about, about what money we were spending at that point, and all of that kind of stuff. And it was one of my favorite exercises as a married couple, just because we were almost always on the same page. It took a lot of the stress out of finances as a couple.
You're using past tense. This is still ongoing.
Well, no. The quick answer to that is no. So Sarah and I aren't actively looking at this. Basically, what we did is we crafted a strategy, and now it's more on autopilot than it is.
So it's like your entry, get everything in, get a account.
Yeah, for us it
was.
was. And the reality is there's just a lot going on with life, and so it can be difficult to do.
Sure.
But even if it's something that you do once a month or whatever, it is valuable. Sarah and I just are at the point now where if we're spending any dollars at all, we talk to each other about the fact that we're spending dollars. And so, or I should say, I talk to her about the fact that I'm spending dollars. She generally has to spend some extra dollars than I do. But anyways, but I will tell you, what is measured improves. I know I keep saying it, but by looking at it, it will improve. Now, if what you need is real dramatic change in your finances, then this absolutely can be a scenario in which you create a budget or use the envelope system. These can be proven systems that can be hugely valuable. It really just depends on what you need. And so the first thing that I would recommend starting with, if you do not have a budget and you're looking to change your spending habits and you want to improve in that area, my first recommendation is have some type of accountability system in place. If you have a spouse, fantastic, this is easy. If you don't, then you should speak to a friend or a professional in order to have some accountability in place. Just pick one thing, like the book day, for example, that I mentioned in regards to my client. We recognized that was his number one problem with spending each month. And so we created the book day. And so he would only purchase books on that day. Now, do you think he never buys a book outside of that day? I think he probably does. This is not about being perfect. It's just like a diet. It's not about being 100% perfect. It's about improving, because you still make concessions on some of those things when necessary.
So how would you go about determining what this is out of balance versus in balance? I mean, one could look at $700 a month on food and be all, that's chump change. I wish I was in that position. I'm not, but that would be the chump. So just determining, this is too much. Is it based on your potential income, or is there like some standardized list that someone could find?
Sure. I mean, you can find, if you just look up, budgets for salary of X, you can find, those types of resources online.
That's really powerful these days, isn't it?
What's that?
The internet is very powerful these days.
Oh, absolutely. Yeah, absolutely. And so you can find that information very, very quickly.
Sure.
Now, the reality is it depends on you. Some people are going to spend more on entertainment, right? Sure. But they spend less on some of these other necessities. Some people have higher medical costs. Some people have, because it varies, it's difficult to say. Some people are what's called house poor, right? So they really don't spend money on a bunch of stuff other than their house, and they have a great house. But they're house poor, meaning they have no cash flow. Sure. Because all of their money is going into their mortgage and the insurance and the utilities and property taxes and all that kind of stuff. And so it really depends on the individual case. But the quick answer to your question is yes, there are generic things out there, then to get something more specific, you really need to meet with a professional. So my clients who come in and sit with me, we talk about the specifics of what they're doing, and then we look at what needs to be reined in. I don't do a tremendous amount of budget creation. It's more a financial diagnosis, right? So we sit down and we look at the areas that are problematic.
Here's a big thing.
Yep. So we look through bank statements, 3 months worth of bank statements. We talk about what their pain points are. What do they need to be spending more money on? What do they want to be spending less money on? And then we craft problem-solving solutions based on those factors. And so, anyways, does that kind of answer your question? Yeah. So that really kind of covers my soapbox on this. We touched on a lot of fundamental principles and fundamental points, but I think that covers kind of the gist of my viewpoint. This can be a little difficult to do in a generic format as opposed to in particular, because I'm the type of person that I want to jump into the data and the specifics and diagnose what's happening based on that information.
Right.
And here we're just talking about just
in general.
In general, here are the good points. And we've had retirement type discussions as well, but a lot of this boils down to, and this is what we started with, right? So to bring it back full circle, we started with in 2018, there was a study, 42% of people retire with less than $10,000 saved. And don't be in that grouping of people. That's a dramatically high number. And so, you've got to be able to make sound financial decisions that leaves you with money necessary. As people are getting older and that kind of stuff. I'm not going to be able to quote the number to you, but I thought, yeah, the answer to the universe. I think that the number was 860,000. If I remember right, there was a kind of a goal number of what you would need depending on your expenses and your medical, because elder care can be crazy expensive and all that kind of stuff. But if I remember right, I think that number was somewhere around 860,000, which is based on 65 until 85 to 90 for high quality of life. What you really want to be striving for, and there are people who do far more than that, and there obviously are people who do a lot less. But your number can be determined by a financial professional, right? You go and you meet with a financial advisor, and you can talk them through what you want, and they can tell you how much you need at what age in order to approximately get that quality of life. So I think that covers everything that I wanted to cover today. Was there anything else you wanted us to go over?
No.
Okay, fantastic. So let's go ahead and jump into the comfort zone. Clark, do you have some questions for us?
Yes, I do. So the first question is, how much money should I keep in my emergency fund?
Okay, great question. Okay. Does that make me mini you? Mini me? Okay.
You literally are.
So this is subjective, not objective, right? So what people want is the right answer. So there isn't the right answer. That being said, the general consensus is 3 months of your income. And so as long as you have 3 months of your income set aside, so if something were to happen, you've got 3 months of regular what your regular earnings would be, then you're set up. Now, there's a lot of conventional wisdom regarding this. Some people want to go as much as 1 year's worth of your salary, 1 year's worth of your income. I don't abide by that. I don't like that perspective because
too much savings.
There's a lot of opportunity costs. Yeah,
Sure.
Exactly. Because that money could be used in other areas. If you say, well, Kevin, I have no debt. My house, my car, everything is paid off, no credit cards, nothing. How much should I have set aside? you need less now, right? This is not the scenario of, well, you need more cash flow in order to take care of the debts just in case something were to happen. Or if you say, well, I have a tremendous amount of debt. Well, great, then you probably should be paying off some of that debt, not having the money sitting in that account doing nothing, because you have the potential to get rid of a tremendous amount of interest that you're having to pay. So no matter where you're at on the spectrum, my thought process is still the same. Yes, you should have some money set aside in an emergency fund,
Right.
no question. But ultimately, I don't think that number should be dramatically high. That's my personal viewpoint.
Perfect. Next question: Robert Kiyosaki or Dave Ramsey?
Okay, so Clark is smiling and kind of laughing when he says this because I use these two all the time. So he knows exactly where I'm going to go by asking me this question. Somehow I'm going to surmise that this was not a viewer submitted question. Okay, so here's my explanation. Dave Ramsey is on one end of the spectrum. Robert Kiyosaki is on a completely other end of the spectrum. The spectrum that we're talking about here is leverage. Okay. Dave Ramsey does not want to leverage the bank's money or the bank's financing or the cons financing options or the credit card. He doesn't want to leverage anything. He wants all debt paid off. Now, I'm not sure what his business model is for his business. I assume his business leverages, lines of credit and that kind of thing. Generally speaking, a business needs money in order to make money, and the more money a business has, the more opportunity it has to earn more money. And in fact, a fiscally responsible, business model. But personally, it can be a little bit different. But either way, Dave Ramsey personally is on the no debt end of the spectrum. Robert Kiyosaki is an author of a book called Rich Dad, Poor Dad. I assume he's written other books, but I have not read any of his other work. Clark, have you read any of his other work?
So I don't know if he personally has written other books, but
Okay.
he has the Rich Dad series
Okay.
where he
Yeah.
partners with other people, and
Yeah.
I've read a few of those, and they're very good.
So Rich Dad, Poor Dad is, if you want to understand leverage, Rich Dad, Poor Dad is a great book to read. I would pair that with reading Financial Peace by Dave Ramsey, though, to make sure that you understand the two different ends of the spectrum. Because Robert Kiyosaki says, if you've got $5,000, you can buy a rental property, right? Rich Dad, Poor Dad really is about getting out of the rat race of the corporate world and really owning assets and leveraging financed money in order to earn yourself more money. So he says, keep borrowing, keep borrowing, keep borrowing. As long as you can earn more than what you're paying in interest, eventually you are at the point where you are, doing more in, cash flow than what these payments are costing you. And so Dave Ramsey is on the no debt spectrum. Robert Kiyosaki is on the complete opposite end of the spectrum. Does that, because that wasn't really a question, because I'm not saying, actually, let me try and actually answer your question. Robert Kiyosaki. Okay, so if what you're actually asking, because your question was Dave Ramsey or Robert Kiyosaki is my answer, mostly because his is a math-based approach. Dave Ramsey is a psychological approach to finances. Now, for most people, Dave Ramsey. For most people, Dave Ramsey. But if you are very math-based, then But frankly, either of the approaches are great. Most people just are on autopilot with their finances. They're
Don't
not.
pay attention.
That's
or
right.
whatever.
They're not thinking about Dave Ramsey or Robert Kiyosaki. They're not thinking. Yep, they're not thinking about getting all their debt paid off or leveraging. The worst case scenario here is they're borrowing with no intent to be able to pay it back or to grow their income to the point at which it will be easy to pay back. So yeah, that's my answer.
Next question: what is the best way to save for my children's education?
Best way to save for children's education. You have some thoughts on this?
Sarcastic ones. I mean, hire them out. Get some child labor going.
Okay. Great. Thank you for your contributions. Let's cover a couple things here. Number one, tuition costs have risen dramatically. All of the financial models that were done in the early 2000s of what you would need in tuition, all of them fell short, and all of them were on the higher end. I'm going to soapbox here for a moment, and not everyone is going to agree with my viewpoint. So please forgive me. But the whole point of this podcast is that we can share, this information that we live in. So here's what happens when the federal government guarantees student loans. Tuition prices increase because the federal government is guaranteeing these loans. And so it doesn't matter what you're getting your degree in. Does not matter. It doesn't have to be a STEM field or a field that needs more jobs. Federal government will guarantee student loans based on your finances. And so what happens is people with low earning potential get degrees that have no real earning potential, and now are using federal money in order to pay for the student loans. The schools are paid. Who isn't paid here, right? The federal government doesn't get paid because, or the person is hit with so many penalties and ends up having wages garnished and all kinds of stuff because they can't pay their student loans because they used federal money in order to get a degree that doesn't have earning potential. So this creates problems economically for the federal government, but mostly it increases the price of tuition dramatically. Now I know this doesn't really sound like an answer, but I'm getting there. Whatever you think tuition costs are going to be when your children are of the age that they're going to be paying for school, if things continue as they are, the prices are just going to be way more than you're anticipating, which means you have to save more than you think you're going to have to. And so now you have to look at different ways of saving the money. For a period of time, Series EE bonds were a big deal. I don't generally recommend going that route. These were education type savings bonds that would help lower the tax impact if they were cashed out and used for education. Those were a big deal for a while. Generally, I don't recommend going the Series E bonds. There were what are called ESAs, education savings accounts, and Coverdell accounts. These were newer, but really have been eclipsed by the 529 plan savings accounts. 529 plans are probably currently the best avenue in order for you to save for your child's college education. Think Roth IRA, but for a child. So child is born, you put money in a 529 plan in their name, they're the beneficiary. Most 529 plans, you can change the beneficiary a couple of times a year. So if you've got a couple of kiddos, you get one that has a full ride, great, you change the beneficiary, or one that doesn't go to college because they get a great job. Without it, you can change the beneficiary, all that kind of stuff. The 529 plan operates as a Roth IRA in the sense that you don't get to deduct it when you put the money in. The tax is deferred until you take the money out. If you take the money out and use it to pay for higher education, then it's not taxable at all. So think about the scenario in which you had the 17-year-old putting $5,000 a year, that resulted in significant returns. Right. The same thing can happen just in a lower time period, but you could double or triple the money that you put into a 529 plan and not pay any taxes on the growth. Right. Generally, the 529 plans are the best way to save for your child's education. For a period of time, there were what were called at least here in Texas, there was something called the Texas Tomorrow Fund. That was buying tuition credits at the price they are now to be used in the future. This program was discontinued very quickly once they found out how much the tuition prices were going up. The parents who got benefit of it got a really tremendous amount of benefit. Some parents served in the armed services, and so they have access to the GI Bill or what's called the Hazelwood Act. Both of those are great ways to help pay for college education. But that's that's not financial planning. That's career path, impacts and all of that kind of stuff. At the end of the day, the best way to save for your child's education is the way that works. And I'm not being deliberately obtuse, right? It boils down to what will you do that will be successful, because what someone is willing to do varies from person to person. And so that's where, as a financial professional, I work with people to diagnose the issues, try and figure out what are they willing to actually do, and then hold them accountable on a continued basis to see if they're actually doing what they said they were going to do. And once you find the one that works, you stick with that.
But all of these options sounded like investing of sorts, putting the money into something that can grow and be more. You generally, you didn't list a start setting aside $1,000 at a time and stick it in your safe in the floor for tuition costs later on, because it's just guaranteed to be, the dollar will be worth less than when you put it into the safe, is what I'm hearing basically. So the line can be, because there are some detriments. Stuff happens when the kid never goes to college. There's some shifting beneficiaries of people who get caught without that, but you shift it to yourself, shift it to a cousin, whatever. I mean, there are ways to get around
Grandchildren.
that. Correct.
Yep.
Yeah. So, I mean, I don't think if you've got an army of kids, so 3 kids, you necessarily need to have 3 different private line plans. My thinking is
I've got
no.
3 different ones.
One
Yeah.
should be sufficient. That way you just shift as it needs to shift. One of the nice things about Home Lines is that it's not only you that contribute to it. So grandparents or whoever could put some money into that as well. It's like a gift type deal.
Yep, absolutely. Generally, it will count against your child for purposes of having assets when looking at financial aid. But the idea is you're trying to help your child be able to pay for school, and so shouldn't necessarily be taken too much into consideration.
Awesome. Next question: what is the best credit card to use for points?
Pink ones.
I like that answer. We'll take that. So
It's also subjective, not objective. That's the right way.
Yeah.
Right?
Fact-based. I hate this question. Because using a credit card for purposes of getting the points, in my viewpoint, is a terrible idea.
If you're going to use the card anyway, having some kind of kickback, I don't think that's the worst idea.
Sure, for sure. But what I see too often is people who spend the card and they justify using the credit card because of points.
Because I get points, this is okay.
And then they don't pay the credit card off when they ought to.
Sure.
And so it's fine, but literally it exists. I mean, who had this idea in the first place? Why'd they do it?
Somebody in marketing.
Yep. Why'd they do this? Because they knew that this would drive people psychologically to swipe the card. Right? These credit card companies exist not because I swipe the card and then pay it off every month. They don't exist because of that. They're not getting anything off of that. They exist because somebody swipes the card and then pays the minimum every month. And this is just a rolling amount. And then that minimum is increasing as they spend more because the interest accruals and all of that. And so these companies live off of these terrible debtors who just are not, well, I say terrible. They're really great debtors because they're not making the payments they're supposed to.
Right.
So, I mean, sure, use whatever credit card you want. But if you walk into my office, and I had somebody tell me once, can I pay the IRS using this credit card? Because I want to get the points. I'm like, sure. The quick answer is you can. Here are the fees. The points are not worth those fees.
Well, there are some odd scenarios where someone could craft like I said, if the credit card is being used in a frugal manner, in the right way, having something set up to have some kind of kickback, where 0 versus some, right? So some of those that offer 1 or 2% cashback at the end of the year, probably an easy default to go to. But if you're one who happens to move around the country a bunch, pandemic notwithstanding, but so like a work type deal, I remember a trick. I don't know if it was really supposed to happen this way. They may have closed those loops since then. But my father, when he worked, he would have to travel for work often. Well, he would swipe his card for his flights, gain miles, and submit for reimbursement from work. And so then he was able to charge the card, get it paid off immediately, and then gain those miles. And so every few years, he and my mother would go to someplace and have a nice vacation and not have to pay for the trip.
Yeah, for sure.
My sisters went to college. He got them flights back and forth and stuff to check out type of things. So I think there's strategies around it, but I 100% agree with that principle of it sounds like a trap question of which is the right one to choose. Don't choose it for this reason, right? Choose it if you're getting a good credit card, great. You're getting a good credit card. Having some kind of kickback is convenient and is a nicety, but think of it like a perk, not a decision maker.
Yeah, the issue that I have with this is the person who contacts me saying they're having problems with budgeting and finance is not going to be using that card correctly. Would you agree?
Sure, yeah.
Okay, so now you understand why I don't like those cards, right? Not because factually they are bad. That's not what I'm saying, right? I'm saying that the people who are trying to get a hold of their finances are not, and who have these type of cards are not using them well. So if you're at the point where you're trying to get a handle on your finances, you're trying to improve and do better, you should not have these type of cards in mind, because it's only going to justify you using it more. And step one for trying to get out of debt is stop spending a credit card. That is literally step one of trying to get out of debt, right? You can either spend less or you can earn more. Or you can do both, but these are really the two ways. And step one is don't spend money you don't have. If you can't pay it, if you can't buy it with cash, you can't afford it, period. There's been this shift in the American economic and financial culture of what the word afford means. What people think it means now is I can afford the minimum monthly payment. Therefore, I can afford to purchase this thing. And that is not what being able to afford something means.
This is where you end up with someone making $78,000 a year buying a $65,000 truck.
Yep, that's right. That's exactly right. I can afford the minimum monthly payment. Barely, mind you, but I can. So now, I'm not going to recall the statistic. I will only be able to tell you that it was over 50% of Americans could not afford an unexpected payment of $500 or more. It was a really, really large amount of Americans who could not afford an unexpected $500 bill. And that's because they are leveraged to the gills. Every dollar of cash flow that they have is being spent on debt that they have, which is insane.
Bad planning.
Yep, terrible. Because what the companies are telling them is, well, we'll give you 0% interest for the first year. All you have to do is make these payments, or no payments for the first year. It's like, wait, you're telling me I can literally walk out of your store with this brand new stuff for nothing? Yes, that's what we're telling. What? Since when are businesses in the business of giving their products away for free? Because they want the 25 or 30% interest that they're going to get. Because who is walking away with free stuff? People who can't afford it. That's who. And so yeah, again, soapbox. I am majorly on my soapbox right now, but it really bothers me when people say that they can afford something. No, you can't. If you can't pay for it in cash right now, you can't afford it. Now, that doesn't mean that you should never buy something you can't afford, but it should be very strategic. Right. It's not like every car I've ever bought I paid cash for, but it should be very strategic in what you're doing and why. So,
awesome. I have one last question. Should I buy a home or rent?
Right now, in the market in the city we live in, should definitely not buy a house. That's my understanding. The realtors that I talk to, people and companies are just able to buy houses for tens of thousands of dollars above asking price. So it's tough to get into that unless you just win lottery.
I mean, this is a market. It is a market-based discussion, but fundamentally, so not taking the time into account right now.
Yes.
Fundamentally, the answer is you should buy rather than rent. Okay, fundamentally. Now, the reasoning behind that is very simple. When you rent, you are paying for a roof over your head. That money is not building equity at all. It's just going to somebody else's pocket. Someone else is building the equity. You are not. So in the scenario in which there's a 2,000 square foot house and you could pay $1,800 in rent or $1,800 in a mortgage, right? So those are your options. then you want to pay the $1,800 into the mortgage, generally speaking. Now, if your cash flow is very low, then the $1,800 in rent will result in fewer maintenance and other out-of-pocket type expenses. Being a homeowner is difficult in the sense that you will end up having more expenses than you expect. So you cannot just compare the rent versus the mortgage. Don't be house poor. One of the biggest reasons that people are financially unsuccessful is because they buy too much house. It is one of the number one problems because they look at what they can afford. And the reality is you're not accounting for all of the other expenses. The HOA, the home warranty, the maintenance and other repairs.
Replacing your AC every decade or so.
Yep, and the roof, and the furnace, and the water heater, and so many different things. And so this is one of those scenarios where fundamentally the answer is pretty easy. Fundamentally, you want to buy rather than rent because buying allows you to build equity. The decision that caused me to have the most financial success in my life was buying my house at 23 years old. So the first house that I bought, I built equity in the house. And when I sold the house almost 10 years later, that equity provided me a lot of flexibility and a lot of options in regards to my finances. And so that was the most important financial decision that I've made in my life up to this point. So I obviously am a huge proponent of buying as opposed to renting. But if you don't have the cash flow, you shouldn't buy. You should rent because if you can't afford the unexpected expenses, because that's what happens when you own a home.
Right.
So, alrighty. Well, I think that's going to wrap us up for today. Thanks so much for joining us. If you're looking for more information or more tips in regards to finances and budgeting, continue to tune into our podcast or reach out to us at molenandtax.com. Other than that, Charlie, appreciate your insights today, and we'll go ahead and wrap up. So thanks so much for joining us. Have a good one.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molenandtax.com.